Well, another day, another record for the Canadian stock market, which has been hitting all-time highs consistently so far this summer, even with still uncertainty for Canada's economy, as we heard from Tiff Macklem, the Bank of Canada governor, this morning. John Zechner is chairman and founder of Zechner Associates and one of our longtime guests. And John, it's great to have you here in studio. Obviously, there's big questions around the Canadian economy, but there's also big questions around what is fueling this Canadian stock market to all-time highs. What have been the driving factors, in your opinion?
Well, it's changed a little bit, John. I mean, earlier in the year was clearly the gold. I mean, the gold had a tremendous run, and obviously the, 12, 13% weighting, whatever that is, of the TSX made a big difference for the Canadian market to outperform the U.S. market in that time. In the last couple of months, the last 2 months in particular, I think gold has probably stalled out a little bit more. The U.S. dollar has had a bit more of a, reprieve and a bounce back. But the rest of the market has sort of filled in that gap and followed with the U.S. recovery. So, financials have done a little bit better. Industrials in particular, industrial stocks up here, rails aside, got whacked pretty hard fourth quarter last year, first, second quarter this year because of the tariff threats. They've bounced back a little bit. Tech stocks, Shopify back. I mean, look at what Celestica, you and I talked Celestica a couple of months ago when it got down to 110 and now it's 280 or something like that.
Yeah.
Because, obviously the spending on data centers is fueling, some movement up here as well. So, that together has gone. So that's, explained, how we've gotten here. And it's just been, it's more in conjunction with the U.S. and some of the cross-border moves and other things like that. But I think, the bigger tale to tell will be the back half of this year economically. And a lot of that we're getting some indications from today from the the Bank of Canada.
I think it's interesting when you talk about valuations, which gets a reasonable amount of dialogue these days because you got those tech stocks at all-time highs. But Bloomberg Intelligence did their own review of the TSX. They found nearly 140 of the listed companies having higher projected earnings growth than the S&P median, S&P average. And yet these stocks tend to trade, according to Bloomberg, at a lower forward price-to-earnings ratio than the S&P 500. Now, I only bring this up because, value investing doesn't always work, but it seems to work relatively well in Canada. And I bring that up because, I know the Mag 7 get all the love, but we're up more than 11% this year. And then in the previous 16 years, the TSX was higher in 12 of them going back to the financial crisis. I mean, this is a market that has generally seen some reasonable performance over the long term here.
Well, it is a more value-oriented market and is economically sensitive on a global basis, John. And you look at, the period of 2000 to 2010, recovered a lot of the underperformance that Canada had in the 1990s when the tech ran the last time around, and then we had the big bounce off in global growth, China growth, everything like that. Commodities ran, energy stocks were big leaders, the metal stocks were awfully good. So, we got a bit of that, similar catch up here. So we are a more economically sensitive market, particularly to the global economy, and that's more of a value orientation. So, the U.S. is more of a bifurcated market. The valuations are really between, the growth stocks, these mega tech stocks, where the valuations are high, but the growth is probably justified to some degree, those valuations, and the rest of the market where, growth is a lot slower. If I back out valuations generally, particularly in the U.S., I still have issues, John, because 26 times trailing earnings. When it talks about forward earnings growth in this quarter looks like about 5% in the U.S. Yeah, expectations are supposed to get a lot better. I think expectations have gotten pretty extended in here and are probably running a little ahead of themselves. I'm very worried about the economy in the back half of the year. I think a lot of what we see in the economic data so far is noise in front of the tariffs. And I think these tariffs take a while to kick in. And I think the economic implications, I think, are quite negative into the back half of the year. Let me elaborate on this a little bit, particularly for Canada, which is why I think the Bank of Canada will go once or twice in the back half of the year. For all the bluster about the trade deals, I don't know, these frameworks, that nothing's really happened, and there's some challenge in U.S. courts to whether Trump can actually get these through, never mind the fact that, I don't know with the European Commission, all 27 countries are going to agree to what was agreed to the other day. The Japanese agreement was based on a government that's not in power effectively. So When this all comes through, I think you're going to see a real negative downturn to the back half of the year. Stunted growth, capital spending sort of non-existent, and employment completely slowed down. And that worries me about earnings expectations.
Well, I think it is important to remind our audience that this morning the Bank of Canada, in their messaging, they are leaving the door open for rate cuts. So they're putting it out there, and then we'll hear from Tiff Macklem later this hour. We'll see what he wants to position in terms of where we go from here on rates. How are you positioning then in the stock market against that kind of backdrop? Like, what's your view right now?
Pretty defensively. We've been lightning into this rally pretty hard. So our equity weightings at the low end of our typical ranges. Within that, we're so much more defensive of, backed interest sensitive groups, pipelines, telecom stocks, utilities to a degree. Still have a weighting in tech, probably 12 to 15%, because that is demonstrated growth, but taking the cyclicals out, bumped our long bond exposure, both in the U.S. and Canada, getting 380 on the long end here, about 480, 490 in the U.S. I think that's attractive as a hedge. Stuck with the gold bet. I think the gold stocks are undervalued. Pulled back on oil and cyclicals, and consumer stocks were very light on. So yeah, we've certainly gotten to a more defensive position, but that's a bit of my client base too, John. It's high
preservation of capital.
High net worth individuals. They don't. In a year if the market's up 20% and they're only up 15, they're not going to fire you. But don't expect a pat on the back in the year when the market's down 20 if you're only down 10. So I take that view a little bit more with my client base.
Sure, but just a quick final question. I mean, when you add up the dynamics of the TSX versus the S&P, the stuff you were talking about leaning into, like as a group, it makes up more the Canadian market than the U.S. market. And the Canadian market has outperformed, at the end of the day, the U.S. market this year. So would you not be surprised if, that sort of trend were to continue for the year, TSX versus S&P, or depends on tech? Maybe.
It wouldn't surprise me, but I think it'll be very sector specific. And so we're rolling to the U.S. for specific sectors, technology, healthcare in particular, and up here we'll play the cyclical stocks because the valuation is lower.
Okay.